The Hull Moving Average is an innovative technical analysis indicator that offers significant advantages over traditional moving averages. Developed by Alan Hull, this indicator was specifically designed to overcome common limitations in traditional moving averages. The key benefits of the Hull Moving Average include reduced lag in signals while maintaining smoothness. It's more responsive to price changes while effectively filtering out market noise. When comparing Hull Moving Average to traditional moving averages on a price chart, the differences become clear. The price, shown in orange, moves with market fluctuations. The simple moving average in red follows with significant lag, while the Hull Moving Average, in green, responds more quickly to price changes while remaining smooth. Notice the reduced lag between price movements and the Hull Moving Average. This allows traders to identify trends and potential entry or exit points more quickly. Traders use the Hull Moving Average for multiple purposes, including identifying trend direction and changes, finding potential entry and exit points, filtering out market noise, and generating trading signals through crossovers. In summary, the Hull Moving Average provides a more responsive, less lagging alternative to traditional moving averages, helping traders make more timely decisions while still filtering out market noise. Let's explore the mathematical formula behind the Hull Moving Average. The Hull Moving Average uses a specialized weighted calculation to reduce lag while maintaining smoothness. At its core, the HMA relies on the weighted moving average, or WMA. Unlike a simple moving average, a WMA gives more weight to recent prices and less weight to older prices. The first key insight of the HMA is the period halving technique. By using half the normal period, this component creates a more responsive average that reacts quickly to recent price changes. Next is the subtraction component, which is critical to the formula's effectiveness. This component takes twice the WMA of half period and subtracts the full period WMA. This effectively extrapolates the trend direction, further reducing lag. The final component is the square root of the period. Using the square root of n as the final WMA period creates the optimal balance between responsiveness and smoothness. Let's look at the key benefits of the Hull Moving Average formula. The HMA significantly reduces lag compared to traditional moving averages, maintains smoothness without excessive noise, and provides more accurate trend identification. To summarize how all these components work together, the Hull Moving Average combines all these mathematical operations to create a moving average that accurately tracks price trends with minimal lag while maintaining smoothness. Let's work through a practical example of calculating the Hull Moving Average on this 9-day price series. We'll calculate the Hull Moving Average using a period of 4. Hull's formula requires several weighted moving average calculations with different periods. First, we'll calculate the weighted moving average with period 4. For WMA, each price point is multiplied by its position weight. More recent prices receive higher weights. The formula assigns weights 1, 2, 3, and 4 to the 4 price points, with the most recent price getting the highest weight. We divide the weighted sum by the sum of weights. Second, we calculate the weighted moving average with period 2, which is half of our selected period. Here, the weights are 1 and 2. Now for the key step in Hull's formula. We double the shorter period WMA and subtract the longer period WMA. This creates a smooth series that reduces lag. Finally, we apply a weighted moving average to the difference series using a period equal to the square root of n, which is 2 in our example. Let's compare the original price series with our calculated Hull Moving Average. Notice how the HMA closely follows the price action while reducing lag. The Hull Moving Average responds quickly to price changes while filtering out market noise. It clearly shows the trend without the lag typical of traditional moving averages. Section 5. Comparing Hull Moving Average with other popular moving averages. Let's examine a price chart that includes several significant trend changes. The simple moving average, or SMA, is the most basic type. It calculates the average price over a specified period, giving equal weight to all prices. The exponential moving average, or EMA, places more weight on recent prices, making it more responsive to new information than the SMA. The volume-weighted moving average uses volume as an additional factor, giving more importance to prices with higher trading volumes. Now let's add the Hull Moving Average, or HMA. Notice how it follows the price action more closely than the other moving averages. At this first trend change, notice how the HMA reacts more quickly to the downward price movement. During this consolidation period, the HMA provides clearer signals by filtering out random noise while still remaining close to the price action. At this final trend change, the HMA identifies the new uptrend significantly earlier than traditional moving averages, providing traders with an earlier entry signal. To summarize, the Hull Moving Average offers several key advantages over traditional moving averages. These advantages make the Hull Moving Average particularly useful for traders who need to identify trend changes early while still filtering out market noise. The Hull Moving Average becomes even more powerful when combined with other technical indicators. There are three particularly powerful combinations we'll explore today: HMA with RSI for trend confirmation, HMA with Bollinger Bands for volatility assessment, and HMA with volume indicators for signal strength. Hull Moving Average combined with RSI creates a powerful trend confirmation system. When HMA shows the direction, RSI confirms the strength of the trend. RSI measures overbought and oversold conditions. The strongest signals occur when the HMA trend aligns with RSI momentum. Notice the strong buy signals that form when both indicators align, HMA trending up while RSI shows strong momentum. For best results, enter trades when HMA slope and RSI agree on direction. Exit when RSI reaches extreme levels, and always avoid trades when the indicators show divergence. Combining HMA with Bollinger Bands allows traders to assess volatility while identifying trends. Bollinger Bands expand during high volatility and contract during low volatility periods, creating a dynamic envelope around the HMA. The most reliable signals occur when price touches a band and then reverses back toward the HMA line, especially when this happens in the direction of the broader trend. Trading strategies include buying when price touches the lower band during an uptrend, selling when price touches the upper band during a downtrend, and exercising caution when the bands expand rapidly, indicating high volatility. The third powerful combination is HMA with volume indicators. Volume confirms the strength of price movements and helps identify high-probability trade setups. Volume often leads price, with increases in volume preceding significant price movements. When combined with HMA, volume can confirm trend strength and potential reversals. The strongest signals occur when the HMA changes direction, accompanied by above-average volume. These high-volume confirmations significantly improve trade success rates. Key strategies include looking for strong volume to confirm HMA trend changes, being cautious of low volume during a trend which suggests weakness, and paying special attention to volume spikes at HMA turning points, which provide the highest probability signals. Let's summarize the key indicator combinations with HMA we've discussed. HMA with RSI provides excellent trend confirmation and works best in trending markets. HMA with Bollinger Bands excels at volatility assessment and is particularly effective in ranging markets. HMA with volume indicators offers the strongest signal confirmation and works well across all market conditions. Best practice suggests combining at least two complementary indicators with the Hull Moving Average to create a robust trading system with higher probability setups.